Further to my video on income versus growth, I wanted to cover bonds. So like I mentioned in that video, on bonds, we receive interest income. And prices of bonds may fluctuate, although we do not rely on bonds for growth. Now, what is a bond? A bond is a loan that an investor is making to a government or a corporation. And in return, the investor gets an amount of interest. The key things to know about a bond are that when you buy a bond or invest in a bond, you expect to get the full amount back at the end of the term or the maturity, and you receive a yield in the form of interest income. Now, there's two major risks that we take on when we buy a bond, and it's not the fluctuation of the market, but rather interest rate risk and credit or default risk. So interest rate risk is the risk that, like we saw this year, interest rates will go up. Now, we're seeing an amazing example of that this year where interest rates have had to go up or have been raised very aggressively and to counter inflation. And so as a result, we've seen bond prices go down quite a bit. That is unusual because it's unusual that we see interest rates move as much as we've seen them move this year. And the reverse is true. So in a year where interest rates go down, bond prices go up. Why is that the case? It's because it makes sense. If you bought a bond last year and your interest rate was 2%, meaning you were earning 2% interest on that bond, and now all of a sudden, if you buy or invest in a bond, you can earn 4%, it is much more attractive to buy a bond now than it was last year, and the bonds that were bought last year are worth less. Now, the second major risk is credit or default risk. Now, all bonds are rated based on by an objective agency, and they're given a credit rating, and it can range from AAA all the way to C or D. Now, everything from AAA, AA, single A to triple B are considered investment grade bonds, and anything below that are considered high yield or junk bonds, which means they're a higher risk of the issuer, be it a government or a corporation, of defaulting on the bond, not being able to pay back the full amount. And so when bonds are riskier or issuers are riskier, they tend to pay higher interest to kind of make up for the fact that you're taking on more risk by buying that bond. Please let me know if you have questions, suggestions, feedback. Have a great day.